Hi, welcome back to Bazaar Morning Call. In our earnings offering quarter se quarter tak, we talk about different sectors and what you can expect from them this earnings season. Today on our radar, we have the cement sector that has gained a lot of traction. Nigel is here to tell us what to expect from this sector this quarter around. Nigel, over to you.
Well, in a seasonally weak quarter, actually demand has been improving gradually as we progress, and in September it was the best. In terms of regions where in fact demand was fairly resilient, you had central, east, as well as other parts of India, East India, they did relatively well as north. Where it was a little bit jittery was particularly in south as well as in west India. You put this together in terms of volume growth for the quarter itself, it's expected at mid single digits, maybe in fact low single digits, at around 4 to around 5%. And for the year earlier, you were estimating a degrowth of close to around 15%. Now could be in single digits as well, a degrowth of single digits, telling you that the second quarter was better than what was anticipated. Now moving on then in terms of pricing, yes, there was a correction because of seasonal factors at play. So in south as well as west, we did have a correction of close to around 2% approximately. However, in other parts of the country, you had pricing that was down by nearly around 5%. So on a sequential basis, yes, price will be lower, but profitability will get protected. Why is that? Because input costs have seen a sharp contraction. Yes, there has been a bounce from the lows, but the negative impact of this price increase, that's in terms of pet coke as well as fuel, that will only be seen in the third quarter of this year. So benign cost, that's what will help profitability. And Ambuja Cements as well as Ultratech, in terms of absolute EBITDA, they'll show a good growth. Let's get straight then to a couple of companies. Ultratech Cement, in terms of the volume growth, it will be only around 2%. But EBITDA per ton will improve by nearly around 90 to around 100 rupees odd. So that's a positive, tell you that input costs will be low, and that's what will benefit them. Moving on then to Shree Cement, the big beat out here will come in terms of volumes, because the market is working with double-digit volume growth, and that's what will help them in terms of their numbers for this quarter itself. Moving to the twins, ACC as well as Ambuja Cements, well, out there they have a master supply agreement. That's the MSA. They'll be saving cost on the back of that. And for ACC, they have exposure to South India. So in terms of the top line, well, that could be a little bit of a compression out there because volumes will be lower. However, the profitability should improve. While for Ambuja Cements, volume growth will be there. Remember, they have a high exposure to West India, but we're working with some kind of volume growth out there. So we'll keep an eye out on Ambuja Cements numbers. Double digit could be in terms of the absolute number. And in terms of valuations, Ambuja Cements as well as ACC relatively cheaper than a larger name like Shree Cement, Dalmia as well in them, much cheaper than the other big names. Back to you guys.
Okay, thank you very much for that, Nigel. Now straight to Navin. Navin, we have seen a decent rise in especially Ultratech and Shree in the last few days, but all cement stocks. Can you give us an idea of how valuations are placed if the earnings indeed kick up both in terms of volume and EBITDA per ton?
So, of course, the stocks are up because the demand feedback of late has been, I think, extremely encouraging. And thereafter, I think if you look at valuations from an FY22 perspective, let's say for an Ultratech, which still trades at about anywhere between 11 to 12 times EV EBITDA, I think these are still fairly attractive valuations, because in the last 5 years or so, these same companies have traded much higher in the band of 13 to 15 times EV EBITDA. Shree, of course, has always traded expensive and continues to trade expensive because of its cost leadership or in general a strong balance sheet. But I think valuations for the ideas like, buy ideas that we have, let's say an Ultratech or an Ambuja Cement or even ACC for that matter, I think continues to be attractive in the range of 10 to 12 times 1 year forward EV EBITDA.
Okay, but Navin, just a little more details on Shree Cements. I heard you mention it, but the stock has not performed at all. Is it purely because of the valuation reason, or is there something else that's sort of keeping the stock from moving higher? And what would your long-term target be here?
So in Shree, of course, the valuation is definitely a concern. It trades at a premium towards entire peer set. So that is clearly one of the aspects. Second is also that I think in case of Shree in particular, since it's already so efficient in terms of whether the use of pet coke, whether the use of a waste heat recovery, in each of these parameters, since it's already so efficient, there is little room for further improvement. So I think that is where probably, like, because stock market or in general investors typically want improvement on each of these aspects, whether it is cost efficiencies or in general. So the volume growth story for Shree Cement, probably if I look at from a longer term perspective, continues to remain intact. But from a very near-term perspective, I think its efficiencies are broadly maxed out, and hence that could be the reason for a bit of a fatigue that you are seeing on the stock.
Okay. Well, finally, can you advise our viewers on what they should look for in cement earnings, and what's your pick of the pack?
Yeah, so our pick of the pack is clearly Ambuja Cement in the large cap space and JK Cement in the mid cap space, primarily by the fact that I think on a year-on-year basis, both these companies are expected to report a massive EBITDA growth in excess of 20-25%. What investors should look for in the current earnings season is obviously the realizations, because what had happened in the previous quarter was there was absolutely no non-trade demand. And in Q2, that non-trade demand, of course, which is seen in the volume traction as well. So in Q2, the non-trade segment, which sells at a much lower prices to the trade, that has come back and come back strong. So realizations, I think there could be some bit of some room for negative surprise there, because you don't know which company has sold how much in the non-trade quantity and at what price, because that gap was a huge 50-60 rupees a bag. So that remains to be watched out. Otherwise, I think volume or the demand commentary from the companies, I think, should continue to be encouraged.
Oh, right. Navin, we will be touching base with you as the big numbers start coming in. Thank you very much for preparing us to face the earnings season ahead. As we wind down on Bazaar, we are finding the markets kind of losing steam. We have just lost the 11,850 mark.